If you had $1,000 sitting in your bank account right now, what would you do with it? Leave it there earning almost nothing? Spend it? Or actually use it to start building real wealth in 2026? The truth is, $1,000 is more than enough to begin investing the right way. You don't need $10,000. You don't need to be an expert. You just need a clear plan. And in this video, I'm going to give you a simple, step-by-step strategy to invest $1,000 smartly in 2026, especially if you're a beginner. First, before you invest a single dollar, make sure you have at least a small emergency cushion. If this $1,000 is the only money you have and you don't have savings for emergencies, your first priority should be building a safety net. Investing works best when you don't need to pull the money out during a bad market week. If you already have some savings set aside, then this $1,000 can go to work. Now let's talk about the smartest way to divide it. Instead of putting all $1,000 into one stock, smart investors focus on diversification. In 2026, uncertainty and volatility are normal. The goal is balance, not gambling. A simple beginner allocation could look like this: around 60-70% into a broad market ETF, 20-30% into strong blue chip or dividend stocks, and 5-10% into higher growth opportunities. Let's break that down. The first $600 to $700 should go into a broad market index fund or ETF. This could be something that tracks the overall US market or the S&P 500. When you invest in a broad ETF, you're instantly owning small pieces of hundreds of companies. That means your risk is spread out. If one company struggles, others can offset it. Historically, the US stock market has delivered solid long-term returns, even after crashes and recessions. This portion of your portfolio is your foundation. It's not exciting, but it's powerful over time. Next, take about $200 to $300 and put it into one or two high-quality, established companies. These are often called blue chip stocks. They usually have strong balance sheets, consistent earnings, and long track records of surviving economic downturns. Some of them also pay dividends, which means they send you regular payments just for owning the stock. Dividends can be reinvested to buy more shares, which increases compounding. This portion adds stability and income potential to your portfolio. Now, with the remaining $50 to $100, you can consider slightly higher growth opportunities. This might include a growth-focused ETF, a technology sector fund, or an innovation-driven industry. The key word here is small allocation. You don't want to risk your entire $1,000 chasing hype, but having a small percentage in growth can boost long-term returns if those sectors perform well. If they underperform, the impact on your total portfolio stays limited. Step 2 is deciding how to invest it. You don't need to invest all $1,000 in one day. In fact, many beginners prefer using dollar cost averaging. Instead of investing the entire amount at once, you could invest $250 per month over 4 months. This reduces the emotional pressure of timing the market perfectly. If prices drop, you buy at lower levels. If prices rise, you're already partially invested. It smooths out volatility and helps you stay consistent. Step 3 is automation. Once you invest this $1,000, the most powerful move you can make is setting up automatic monthly contributions. Even if it's just $100 per month, wealth isn't built by one investment. It's built by repetition. The $1,000 is your starting engine. Consistency is what fuels it. Another important step is mindset. In 2026, markets may move up and down frequently. Headlines will always predict crashes, recessions, or booms. If your $1,000 drops to $900 temporarily, that's not failure. That's normal volatility. Long-term investors expect fluctuations. The mistake most beginners make is panic selling. When you sell during fear, you lock in losses. When you stay invested, you give your portfolio time to recover and grow. Let's also set realistic expectations. Your $1,000 is not going to turn into $10,000 overnight. But if the market averages around 8–10% annually over the long term, and you keep adding to it, compounding becomes powerful. For example, if you invested $1,000 today and added $200 per month consistently, over 10 years the growth could be significant. Time matters more than timing. One more thing smart investors do in 2026 is avoid hype. Social media will always promote the next big stock. But building wealth is usually boring. It's diversified ETFs, it's steady contributions, it's patience. The goal isn't excitement, it's progress. So here's your simple, step-by-step recap. First, make sure you have basic emergency savings. Second, divide your $1,000 strategically, majority into a broad ECF, a portion into quality companies, and a small percentage into growth. Third, consider spreading your investment over a few months to reduce timing risk. Fourth, automate monthly contributions. Fifth, stay patient and ignore short-term noise. In 2026, the biggest advantage beginner investors have isn't secret information. It's time. The earlier you start, the more powerful compounding becomes. $1,000 invested wisely today can be the beginning of a portfolio that grows for decades. The difference between people who build wealth and those who don't usually comes down to one thing: action. Not perfection. Not prediction. Action.